Good afternoon, everyone, and welcome to the January Monthly Market Monitor. I am Chad Ellenberg, Investment Analyst at Corporate Central Credit Union. We'll be going over quite a few slides today, so grab something strong to drink, strap in, and get ready. As we look at the unemployment rate for November at about 4.2%, you can see it's been ticking up since about mid-year. Although the unemployment rate can be a bit deceiving, and we'll dig into a little bit more data later. Wisconsin unemployment rate generally behind the nation. You can see right now we're at 2.9%, quite a bit lower. U.S. unemployment rate, take a look at the map. Of interest, when last we spoke in March, you can see some of the changes. What I referred to as the Illinois contagion. Some of the states around there, specifically Michigan, we'll talk a little bit more about that, as well as Kentucky. But you can see overall some improvement over on the West Coast as well as the East Coast. Full versus part-time employment. When last we spoke, both full-time employment is up 0.5%, and part-time employment is down 0.5%. So you can see those people transition from full to part-time, which is a good sign. However, in the next slide, you can see that this is trending down. Hours worked, less than 35 hours is trending up, and 35 hours plus is trending down. This is going to fit into the overall narrative that I'm presenting today regarding a softer jobs market in 2025 and some of the things potentially on the horizon. The impact of immigration. I think this has been talked about quite a bit, that native-born workers still haven't been restored to their previous work levels. You can see this is through Q4 of 2023. Ultimately, it seems like by year end, it will have taken nearly 4 years for native-born Americans to return to the job market. On top of that, if you were to estimate the unemployment, illegal immigrants here, the unemployment rate would tick up. Continuing jobs claims have been very steady since 2022, very modest growth. Job vacancies, again, this kind of fits into our narrative. You can see little change at 7.7 million, but if you look at this overall trend, definitely moving down. Number of separations is also a little changed at 5.3. But as we dig into this data, you're going to see that 80% of job growth is coming in 3 areas. Government employees, this is certainly one of them. And if you look at the steepness of that hill from 2020 through 2024, I mean, that is a pretty significant increase in government employees. And you can see that in October of 2023, 58% of all the new job hires were in government. So a lot of these employment numbers are being skewed by government. In government growth, why is it concerning? Well, for one, we're in the midst of what could be termed a private sector recession. I'll let you read that. Private sector is staggering or shrinking. And remember that these government jobs and government spending is all done through the private sector and through our tax dollars. Right now, the trend we may be facing right now is increasingly driven by government spending. We're certainly going to look at some graphs later to show the slope of the curve as far as government spending and transfer payments, and largely spending through deficits. We'll definitely look at that later, the debt and the deficit. And right there, 3 industries accounting for 83% of growth: government, healthcare, and hospitality. Private sector employment, I thought this was particularly interesting. Again, this only goes through March of early 2024, but it had always been the old trope that you work in government because you've got a stable job and you've got a good retirement. You can see that the public sector is now outperforming the private sector in compensation. Private sector employment, if you look at that overall from January of 24 through this year, through October, you can see not very robust private sector growth, which feeds into everything we're talking about, a tightening job market. When I cautioned you earlier to be skeptical of jobs data. Again, this is through March 2024, but you can see 818,000 non-fewer jobs were created than what the government had originally reported. We've seen these revisions over the past 16, 24 months. You can see pretty substantial as far as professional and business, as well as a lot of the working class building this country, the manufacturer and the construction, trade and utilities have really been behind as far as what government projections were. ADP job data. This came off today. Again, as I cautioned you just a slide ago regarding bad data, the ADP jobs data is about the worst you can get. It's not very accurate, which is why the markets actually moved in the opposite reaction of what you might expect it to today. But you can see from their projections, 122,000 added, the fewest since August. Private sector hiring and wage growth slowed in December. That I certainly believe. And a moderation in demand for workers. Yes, I do believe all of this, but I don't know that those jobs numbers are that accurate. Purchasing power. This is something important to look at. The raising effective costs and services per unit of money. You can see that through the last 4 years, this has really trended down, which anybody who's been to the grocery store or purchased anything is certainly aware of. And with consumer purchasing power, you can see the CPI that this has risen. You can also see the slope of that line, which interestingly enough is close to government spending. Temporary employment. This is a leading indicator. Again, when you look at something like this over the past year, it certainly shows the tightness in the market. Employers aren't bringing on people temporarily. Less seasonal help, looking within, extending hours. Permanent job losers. These are truck drivers and other openings. But these permanent job losers are rising at a raising rate. Generally seen in recessions. However, I'm not seeing anything recessionary here, but you can see this period from September through November, significantly a lot of job losses. Initial jobless claims are relatively flat, consistent within range bound over the last couple of years. The U6 rate, this is unemployed, marginally attached and part-time people looking for full-time work. That's the key. Looking for full-time work. If someone isn't looking for a job, they're not included in unemployment. But you can see this is also picking up as well. More people who are working part-time and would like to be looking for full-time or are currently looking for jobs. And you can see since December of early 23, this has certainly picked up as well. The labor participation rate, I think it's worth bringing up that during the 90s, it was at 67%, pre-pandemic about 63.4, currently about 62.5 and trending down. I'll hear the argument that this is due to boomers leaving the workforce. However, I'll go through a graph later that's really kind of going to dispel that myth. Multiple job holders, again, these are both primary and secondary full-time jobs. You can see this overall trend. It so far peaked in about late 2023 and has since come down. Retail sales are relatively soft for 2024. I guess we did have some peak months in July and September. We still won't have the December data. The trade gap in billions, you can see that since the shutdowns, since the coronavirus, it's certainly exploded. We were making progress 2015 or 2016 and 2015 through about 2020, but you can see what's happened since then. The personal savings rate, it's a little misleading. That's 7% before the pandemic. That was a bit of an anomaly, but still well above 5%, 6%, usually around there. And you can see we dipped now beneath 5%. And we'll get into some of those factors. Obviously, credit card interest payments are very high, mortgages are high, automobiles have been very high, and student loan debt is also increasing. So as we look at this now, you can see that obviously mortgages are a huge chunk of this. When we look at the average price of a house in a couple of slides, you're going to understand that. Auto loans, anybody who's purchased a vehicle since 2020 has seen the prices explode and not really come back down, even though its inventory has corrected itself. The credit cards, very high interest payments, and student loans too have also exploded. Charge-off rates for credit cards, you can see that it increased to 4.65%, up at 4.36%. This is the highest level since the third quarter of 2011. And you can see this very steep slope on the bottom since 2022. So obviously this is going to impact our members. It's going to impact you who run credit unions as well. And you can certainly see that this doesn't look like it's slowing down at all. If anything, it's picking up a little bit. The annual growth rate for the third quarter, 2.7%. For an economy this size, that's really not that bad. 3% for a long time was thought to be what you would want, what you'd expect for a mature economy like we have. We've certainly seen that we've been able to outgrow that pace in the past. But right now, we've kind of settled into around 2.7%. And a lot of this has to do with debt and the deficit. See the annual growth rate over the last 5 years, 10 years, I'm sorry. I mean, relatively consistent. Obviously, coming out of 2020, we had that huge boost when things reopened. Government spending, you had student loan deferment, rent deferment, a lot of cash in people's pockets that they burned through rather quickly. Government spending to GDP. So the United States last year at 36%, 2024, averaged 25.68% from 1900 to 1923, an all-time high of 47% of GDP in 2020. So you can see this is pretty staggering. Even more important is I would look at this overall trend up. You would expect we tried to stimulate the economy with low interest rates, and then all the things that I've previously discussed, student loan deferment, rent deferment, obviously sending checks out, but you can see the rate of government spending has increased since then. Debt to GDP, that's a whopping 120.7%. And if you look at the slope of that line again since 2023 with government spending, it's picking up again. So the government is financing itself, financing government employees by borrowing and at much higher interest rates than what we had seen pre-pandemic. The budget outlook, I just draw your attention to 2034. You can see the amount of publicly held debt. That's $116 trillion. So it's pretty staggering to think about the slope and the impact of spending is having on our children and grandchildren's futures. Housing starts. You can see it trimmed down towards the end of the year. That's not unusual. There is some seasonality in housing starts. Obviously, it's hard to break land in the middle of winter in some of the northern states, some of the Midwestern states. Existing home sales ticked up a little bit. That's a bit of an anomaly. There's not a whole lot of inventory. And obviously, home prices being around $400,000. You're also looking at interest rates. Why would you get out of a 2 handle to get in a 6.5 handle? So there's a number of factors in place right now. Here's the median price that we just talked about. You can see we're up at $406,000. Gone are the days of the $100,000, $125,000 starter home. You can see those have been replaced by modest houses that are double the price they were just a few years ago. Also, that people should think about is the demand for housing. That certainly hasn't decreased with the amount of immigrants who've been allowed in. So certainly that is going to place pressure on housing prices. 30-year fixed rate average, about 6.58%. MBA refinancing, as we spoke about, unless it's a case of death, divorce, dislocation, even downsizing, I would remove, because you'd be downsizing into a house of relatively the same size for the same price at probably a higher interest rate. So you can probably throw that out. So unless you have to, It's a very challenging environment to refi. I would also point out that that September 50-point basis cut did encourage some people to do it. More modest change in the December 25-point rate cut. The annual inflation rate at 2.7%. If you look at the one on the bottom, that graph on the bottom, that's pretty telling that the growth of inflation kicked up to 9.06%, and obviously the growth has still come down. But as we look at a graph in the future, it's going to give us a little bit more context. Core inflation rate about 3.3%. So again, settling back down, still well above where we were pre-pandemic. So if you look at this from March of 2021 through March of 2023, there's a 2-year period where inflation is outpacing job growth, wage growth. And you can see it's pretty substantial difference. When you look at that, you understand why the inflation was one of the key issues in the presidential election this year. You can see how difficult it has been for people to catch up, how difficult it's been to save money. And you also look at the price of homes, automobiles, price of groceries, all these things are factored in. The misery index, I think this is a really good, simple, down and dirty explanation of why exactly things are happening. And it's pretty simple. It's the annual inflation rate added to the seasonally adjusted unemployment rate. So we look at this graph in the lighter blue, going vertically, that is the presidential party. And then as you take a look at this, even Reagan at 12.1%, that misery index came down from over 17%. And Bush dropped that a little bit further. Clinton at 5.2%, the lowest since 1948. And even President Trump before COVID at 6.1%, which is the second lowest going back to 1948. Joe Biden at 9.2. So it certainly made Kamala Harris's election, some would say a second term of Joe Biden, very challenging. We've got a 9.2 misery index, which is well above the average. Producer price index. This is another important graph I like to look at. You heard a lot about supply chain management and supply chain problems, especially coming out of 2020. And some of that still exists, but there's a big component of this, which is regulations that make it expensive for manufacturers, creators, builders to create, build, and distribute goods. So the greater piece of the regulatory part obviously gets passed on to consumers at some time. I'd say more worrisome is if you look at this since September of 2022, this is heading up, not down. It doesn't look like there's going to be any relief for producers, which means there won't be any relief for consumers. Take a look at some market slides. I threw this in here because I thought it was interesting that if you look at 2023, what the predictions were for 2024, they were looking at about 1.75% in rate cuts. So what did they really get? They really got 1%. So quite a bit different. It makes it challenging to control your balance sheet. It's why it's important when you look at having things like negative correlation, or when you set up your balance sheet with asset liability management, that you look at both sides of the balance sheet and understand your duration and any mismatches you may have. I threw this in again from 11/29/24 just to show how quickly this has changed. So you can see there was a consensus for 2 rate cuts, one in December, which did happen, and then one in July of 25, and then a rate increase in January of 26. If we look at today's, gone is any kind of rate cut or increase. There's no consensus for either one right now. So they're predicting a pretty flat yield curve. We're starting to see that as well. A little bit of slope getting back into the forward curve, which is a good thing, meaning that you're getting paid for your credit, liquidity, interest rate, inflation risk that we haven't seen for a while. It's very modest, but it's starting to show itself. I threw this in just to be cautionary about how quickly the work can change, how quickly consensus can change. But as of now, there is no consensus on a rate cut through 2026, almost mid-year. Yield curve, again, I ran this from 2021 to 2025 just to show you the significant change, obviously, within that time period. You can see there was some slope in the curve back then, more of a normal looking curve versus the very flat curve we have today. But fortunately, with the exception of that one kink at the 1 year, we're starting to see some very modest slope built in. Again, with projections with no rate cuts, we'd expect to be a fairly flat curve in 2025. Taking a look at the yield curve year after year, you can see a bit of a twist going on with the lower end coming down and the longer end coming up. That's pretty visible. And month over month, again, with some of that consensus, some of the change in the work, you can see starting to get a little bit more of a normal looking curve. 3-month treasury, again, this all plays into what we've been talking about. Relatively flat curve. You can see this is projecting that. 12-month treasury, a little bit of slope in that, a little bit of rise, but you can see currently rather flat. 3-year treasury on a 1-year horizon. This is rising rather modestly, but again, this is just some of that gentle slope we've been talking about. The 10-year treasury, same thing. SOFR rate. So this is a rearward looking index of the average. So this would play out just exactly as we expect. When there was the 50-point rate cut, in September. There's 25 points in November and then another 25 points in December. Term SOFR is forward looking. Sometimes if there's expectations of future rate cuts or hikes, you can see it generally in the 1 or the 3-month when they get inside of that band. So the 3-month would be a better predictor. Although it's not as good as LIBOR had been in the past as a predictor. So if we look at the term SOFR for the 3-month, you can see relatively stable, steady rates. Certainly predicted that September cut, the modest November and December ones. Currently trending down. We expect that to level out a little bit. Again, unless the Fed makes a big move. And I know that President-elect Trump comes from a business background. Wall Street likes cheap money. So he may have tried to apply some pressure, but with inflation still being sticky as it is right now, that might be a challenging prospect. So taking a look, we looked at commercial real estate last time. If there's any good news, it rose at a slower pace than it had been since the fourth quarter of 2024. You can see the value of distressed financially troubled assets reached 102.6 billion. Offices constituting nearly half of the market distress at the end of September, 50.2 billion, which you'd expect. Potential distress, what may perceive full-blown financial trouble, stood at 260.9 billion. And as you look at these graphs on the left, you can see that it certainly has been challenging. As we look at this, the phantom debt also, we spoke of this. This is the buy now, pay later. You may see this on Amazon or on websites, 4 easy payments. The problem with this is there's a lot of people who are using this, borrowing Peter to pay Paul, just paying small installment plans. We've seen this with the savings rate too, that's down. Inflation, the rate of inflation decreasing, but it's still being relatively high. And then you look at all the expenses currently, mortgages, cars, all these other expenses. So this is another hidden time bomb that's not being tracked very well. Employment rate by age. This is actually through 2023. I wish they had the data through 2024, but I think of interest is if you look at that 25 through 45 to 54, they've kind of reestablished themselves at above 80%. But of interest is that 16 to 24 has really swung down, while the 55 and over, obviously, that it is not just baby boomers, that's a number of other people, but that has swung back up. It'll be interesting to see if this continues, but you can see that after the pandemic, a lot of people probably lost part of their savings and moved back into the workforce. So it'll be interesting how this shakes out in 2024 if this continues with the 16 to 24 year olds. Also, of interest is I don't know how many of are working a cash job. I think that's very prevalent now. 13 to 16 year olds, even 17 year olds, where it's to their benefit, to the employer's benefit to just work cash. So it might be part of that underground economy as well. We look at contributors to the U.S. debt. You can see our receipts on the left, taxes, Social Security, some of these social insurance. You can see on the right these outlays, Social Security, healthcare, net interest. That is of particular interest when we look at the federal deficit. Remember, this is not the debt. This is just the deficit. This is just the year over year shortcoming. And you can see that projection through 2040 to be 8.9 trillion. That's not even our total debt. That is just the deficit that we continue to pile on each year. U.S. government will record 1.2 trillion in debt payments in 2024. That's the highest ever. Interest payments are driven by a combination of deficit spending, especially during the pandemic, and the Federal Reserve's campaign of anti-inflammatory and interest hikes. So you can see, but I think important is this slope of that line. From 2020 on, we've seen government spending just explode to unsustainable levels where it was probably relatively unsustainable before. But even worse now is they have to borrow, at a much higher rate. And then if you look on the left, after Health and Human Services, Social Security, there's interest on your national debt that's outpacing defense and military programs. So of that 1.2 trillion, if we didn't have that debt, obviously it could be spent other ways, infrastructure projects, human services projects, a number of other things that could be done instead of just financing the interest on our debt. Personal income, so this is transfer receipts. Again, this kind of jives, not quite the same slope as we had seen with government spending, but of interest is if you look at the slope of the line pre-2020 and then around 2022 and how it resets itself higher. So coming out of the pandemic, coming out after all this government spending, in the past, historically in the past, and I'm talking about 20, 30, 40 years ago, you would see government spending reset itself lower. This time it hasn't. You can see that slope has picked up since late 2023 and 2024. Again, borrowing money we don't have to pay for these programs. If you want to be depressed, take a look at the current U.S. debt calculator. 339 million people in this country, 323,000 debt per taxpayer. The national debt, 36.3 trillion. The total debt, which includes households, businesses, state and local government, financial institutions, and the federal government, is at $101.1 trillion. So that's Death Star money that you're looking at, the amount of debt that we're rolling up right now. We looked at, I threw this in here because earlier this NABER, NABER recessionary index, as we looked at it in March, it did show that it was a possibility of a recessionary period. You can see since then, recession is unlikely, although we're certainly seeing a tightening in the job market. Bankruptcy filings, 2024 witnessed an uptake 12% of total filings compared to the same period. Chapter 11 cases, filed troubled businesses seeking reorganization. Back to my Illinois contagion on the bottom. Michigan, which has seen 4 tax hikes in the last 4 years and now has and now whose unemployment has grown, also is showing rising Chapter 7 activity. There's not much good news to take out of this graph, except for the fact if you look at year end, down compared to where they had been in 2022 and 2023. Each one of these lines is a 4-week period within a month, which is why it looks a bit choppy like that. But you can see at nearly every point over the last 12 months, there have been a greater number of bankruptcy filings. The Fed meeting dates for 2025, this is something you want to keep in your calendar. Understand how to manage your balance sheet, possibility of rate cuts. Obviously, that's going to affect your cost of funds, cost of borrowing, number of other things. But these are the dates here. That's all I have for you today. Does anybody have any questions of me? I'd like to thank you for joining us. Wish you have a great week. Thank you.